In fact, stellar listings, all three of them. We addressed Vishal, Megamart and MobiKwik previously, but let's talk about Sai Life Sciences. They made their D-Street debut at 650 rupees per share, which is a premium of 18% to its IPO price of 549. The company's 3,043 crore IPO saw a subscription of 10.27 times during the 3 days of bidding between December 11th to December 13th. To discuss more on the company's future plans, we are now joined by Krishnam, Raju, Kanumuri, who is the MD and CEO of the company, joining in now. And we also have Sivaramakrishnan Chittor, who is the CFO of the company. Gentlemen, good morning. Thank you so much for joining in. And finally, the listing is done, so we can get more out of you in terms of the outlook going forward. Mr. Krishnam, let me start with you. Now that we are through with the listing as well, if you can share your growth plans. The first half saw a single-digit growth for you. What are the plans going forward for FY25 and especially FY26? Now that the debt will be lower, you will be able to finance it with the IPO proceeds.
Look, I think I just don't want to get into the exact numbers yet, but essentially our growth plans remain pretty aggressive going forward. But I'll just point to the market opportunity in front of us. If you look at the global CRDMO market, India is only about 5% of the size of China. So I think the potential of repeating the growth for the industry at large is pretty significant. So I think the opportunity has to be a multi-year, 5-10 year opportunity, and the scale opportunity is significant. And to that effect, we actually do have significant capex plans going forward. We are working on those capex plans along with our customers to figure out what is important for them in terms of technology platforms, scale. So we are actually working very closely with our teams to outline a capex plan, which we will finalize in the next few weeks. We have enough visibility in our revenue that we will be generating internal accruals, healthy internal accruals in the next few years, along with some debt capacity. So we think we have enough capital to fund our expansion for the next few years going forward and to maintain high level growth as well going forward. And just pointed to you mentioned a flattish growth. If you look at historical numbers, our second half has always been stronger than the first half of the year. And historically, this industry itself is not quarter to quarter, is lumpy. And so I think we just historical trends wise, in fact, ahead of in terms of EBITDA growth, even what we were last year.
So Krishnam, just as a follow-up, since second half of the year stronger than first half, with the strength in H2, do you think for the full year you will get back to at least a double-digit kind of a revenue growth? And also, you know, revenues have been a bit lumpy. FY23 was 40%, FY24 was about a 20.4% top-line growth, and then H1 was 5%. You know, how should we read this?
I think you will have to assume that the lumpiness is going to stay in the business. This is just the nature of CDMO business, because essentially you're going with the product development life cycle. You're not dealing with mature products. These are about new products launching in markets, coming and going to phase 1, phase 2, or multiple phases based on clinical data. So inherently, these products are now going to have a long-term scope until they hit commercial. And even commercially, you have different phases like launch phase. So there are multiple aspects which make it inherently lumpy. So you'll have to track this business really on an annual or multi-year basis. So I think what you will see is double-digit growths should not be a challenge mostly going forward. But I think the opportunity is much more significant than that as we look at it.
Okay, so double-digit growth is something which is possible going forward. Mr. Chittor, let me get you in the conversation as well. So you are so Mr. Krishnam spoke about the opportunities which are available going forward. What do you think in the near term would be an EBITDA driver or an EBITDA trigger for the company? CDMO is a market which is growing very well. Can you give us a sense of what is the EBITDA margins the street can work with? And what would the capex do to it? What kind of capex are you looking at? How much will you be spending? If you can give us that amount.
Sure. So I think if you look at the 12-month ended September 24, we presented the September 24 data in the document that we had presented to the public. If you look at the September 24 12 months, we've actually clocked closer to a 24% EBITDA, which is up from the number that we presented for fiscal 24, and that is up from the numbers that we presented for 23. So we believe that there is leverage at play in the business. the CDMO business, particularly the manufacturing business, tends to get, provide leverage to the business, particularly when molecules are scaling up. We mentioned earlier that our business has a lot of commercial molecules. We talked about 38 commercial products, which are fairly early in their patent life, which just gives us an ability to scale and grow. And as we scale and grow, we believe operating leverage is a natural consequence of that action. And I think that would help us grow our margin, and growth of margin is a big focus within the organization. The entire management team was focused on that.
Chittor, Mr. Chittor, what's the view on reducing your dependency on raw materials imported from China? Currently, it's close to about 30%. Do you all wish to bring it down? If yes, how would you go about it?
Yes, so I think the way we've looked at it today, I think every product that is going into a late phase, which is phase 2 and later, there is a very specific activity that we conduct by product, looking at the scope for the raw material. We actually take a look at what can be done, how can this be outsourced. We work with a lot of Indian partners to kind of get these products locally sourced. And as part of an overall strategy, we kind of reduce dependence as products become commercial. There are early phase and very early discovery molecules that we buy. We do have some amount of exposure with China, but I think we are constantly working to reduce that. But we already have anything that is commercial and larger volume. We have now a specific program in place that kind of continues to reduce. And if you look at our historical trends, we have significantly reduced dependence on China, just from a potential disruption of supply.
Just one final question, Krishnam. There is a lot of uncertainty, ambiguity surrounding the US Biosecure Act. It could get delayed, the form may change. What are your clients telling you? And if it doesn't go through, would it be a big hit to the kind of opportunity that lies in front of you?
To be candid, I think if you look at historically last 3 years itself, we've seen a significant change in customer behavior. Post-COVID, I think most companies were looking at diversification of supply chains. I think that was primarily really driven by being a single source in the core situation. But over the last 2 years, most of our customers have voiced, even before Biosecure came about, and Biosecure was only 6 months old, a phenomenon, but the diversification started almost 3 years back. And customers have consistently said that they want to have alternate supply chain, which is equal size to China at least, because they want a true redundancy. It's not really China plus one anymore. And I think companies have taken a long view on it. They have not taken a short view on it. They understand China has built huge capacities, but they expect over the next 10 years to build up significant capacity overseas in terms of partners they choose and build with them. So I think this is a multi-year opportunity for partners who do choose to invest with them and work with them. But again, this industry will have few winners. It's not going to be a case where there will be 10, 20 companies benefit. There might be 5, 10 companies. But these companies will be much more integrally involved in the supply chain of global innovative pharma companies. And I think, I really don't think this is going to have a really adverse impact in terms of the long-term secular trends.
Okay, all right. So we'll watch out for that. Thank you so much, Mr. Krishnam and Mr. Chittor, for joining in today with your thoughts and the outlook going forward. That's the debut of the new kid on the block, Sai Life Sciences, doing really well. The stock is up 40% as we speak. Let's slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Stay tuned for that.